This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only.
This week we're fortunate to be joined by a special guest, Alan Kohler. Alan Kohler may be known to many of you. He's certainly been known to me for many years, and I've known him for a long time. He started at the Australian as a cadet back in 1969. He's had stints at the Fin Review, writing the Chanticleer column as editor, periods at The Age, writing in the Herald, the Australian, obviously these days the ABC for the last many years now, in fact. And of course, he's also a columnist for the New Daily. But one of the big things at the moment, he's got a book out called The Great Divide by Alan Kohler, which started off as an essay and has been expanded into a book, which has recently been released, which we'll talk about in a moment. So welcome, Alan.
G'day, Shane.
G'day.
Diana.
Hi, Alan.
So just a bit of discussion about the economic outlook. It seems to me things are quite uncertain. We've obviously got these tensions in the Middle East, debate about whether we're going to have a recession or not in Australia or globally. Central banks are cutting rates, but the RBA's behind a little bit. I know you're not an economist or into point forecasts, but what's your take on things at present?
Read the Middle East. I think the big uncertainty, the big question now is, what does Israel do? And will Israel attempt to destroy Iran's economy by knocking out its oil production capacity? So that's, if they don't do that, it's probably not going to be that big of a deal. Yeah. If they do that, then in a sense all bets are off, and we could be in for an oil shock. Now, Iran's oil production is, I think, less than 5% of global capacity. So it's not.
It's about 3%. So.
Yeah, so it's not that big of a deal on its own. Iran, however, would likely respond, it's felt by those who know. If Israel did that, they'd likely respond by trying to knock out Saudi Arabia's capacity, and really the whole thing would blow up. Obviously, if oil couldn't be produced by Iran, their economy would probably collapse in the sense that their currency would collapse and they'd end up with hyperinflation of some sort. So, obviously I have no idea whether Israel will do that, but that seems to me the key question.
Yeah. As
to what Israel does. I mean, more broadly on sort of economic outlook and so on, in markets, I was just reflecting the other day that, the long-time Fed chairman during the 50s and 60s, William McChesney Martin, who you'll remember, he said that the job of a central banker is to take away the punch bowl when the party's getting going. And that was certainly the case back in those days, and with Paul Volcker and so on. Mm. But it seems to me that's all changed now. The central bankers don't do that now. The central banks basically say the punch bowl stays. Mm. And they might take it away a little bit or,
put some more back in.
But they just kind of put it back. Mm. And so I think that has fundamentally changed the way the economy and the markets work. Mm. In the sense, it began with what was called the Greenspan put, and then it became the Bernanke put and the Yellen put and so on, and it started with the 1987 crash. Greenspan came in and sort of rescued things. But it just seems to me that with each crisis, 1987, 2000 dot-com crash, GFC, each time the central banks have intervened a bit more. Mm. And with the pandemic, it was like full on, interest rate zero, money printing, everything was just absolutely flat out. And so now I think basically they've abolished recessions to the extent that they can.
If they make a mistake, you could get one. If they take a little bit too much out of the punch bowl and go a little bit too far and miscalculate.
Yeah, but they're able to and are reacting very quickly to stuff. I mean, I think it's going to be really tough to have a recession now.
Yeah.
I don't think the central banks or the governments want recessions. Mm. I mean, obviously what's going on in the US is both fiscal and monetary policy. the Fed started cutting interest rates, but fiscal policy has been so stimulatory in the US. The deficit's 7% of GDP. It's massive. That's not so much in Australia. We had 2 surpluses in a row, and the Reserve Bank is still hanging on to 4.35%. But I just, for some reason, in the old days, with Paul Volcker, no problem. Recession, 15% unemployment, no problem.
I guess you could argue they were trying to squeeze very high inflation out of the system, whereas these days, we had a bit of inflation recently, but it's quite modest compared to what you had back then.
Correct, that's right.
So they haven't had to go as hard as they used to, which means alternatively, when things start turning down a bit again, they've got more flexibility to ease quickly, which perhaps is what they're doing.
I mean, I do wonder whether the Phillips curve applies anymore, which is the relationship between unemployment and inflation, which was described by Bill Phillips back in the 50s. So, and it seems to me the central banks have kind of entirely based their operation on adjusting unemployment to adjust inflation. And I'm not sure they want to do that anymore. I mean, the Fed is clearly trying to ensure that unemployment doesn't go up much.
Well, I guess one aspect of the US, I mean, it's fairly optimistic, you could argue, is that they've been able to get inflation down without a big rise in unemployment. In fact, Greenspan said this, we've been able to adjust without opening up a lot of slack in the economy. And that, I think Jerome Powell, I think I just said Greenspan, Jerome Powell actually said that. So you could argue that things have worked out pretty well for them. And now they're in a position to say, well, we've got inflation coming down, so therefore we can ease up. And other central banks are all doing the same thing. They're all in alignment. Inflation rates everywhere have been coming down almost as quickly as they went up, which you could argue is a cause for optimism.
Yeah.
Particularly if you don't get a recession.
Well, it turns out that inflation was transitory.
Yeah, I reckon when we look back in a decade, you say, oh, what was that little blip there? Oh, well, the transitory surge in inflation.
That's right, due to the pandemic and the supply chain problems.
Yeah.
So, you're right. I mean, but maybe that's just inflation coming down of its own accord.
Yeah. Then again, maybe if they hadn't acted, then you would have ended up, it may not have been transitory. So
but we'll never know, will we?
We'll never know.
Because they did act.
They did
but as you say, they didn't act that much. I mean, interest rates in the US, went to 5.25% or whatever, and that isn't what happened under Volcker.
Yeah. I guess the other part of Powell's comment was that a learning from this period has been that if you have credibility in terms of getting inflation down, then you're able to get inflation down without opening up a lot of slack in the economy. So it's the very fact that the central bank did aggressively raise rates and had credibility. People believed it. And therefore that's what worked, whereas in the 1970s you didn't have that.
That's right. And that's kind of, in a sense, that's what Bernanke brought to the table, which was forward guidance, the use of words by the central bank in addition to actions, which they now routinely use. They're jawboning, as it's called.
Yeah.
So I guess your thesis that we're addicted to what central banks are saying and doing, do you think that the same applies to the government? I mean, since the pandemic, we've sort of seen this big reliance on government spending to stimulate the economy, and that's clearly happening in the US with such a large budget deficit worth 7 or 8% of GDP. In Australia, you said the budget deficit, well, we have a surplus at the moment now, but we've still clearly had a lot of spending in the last few years. Do you think that the government will do anything in their power as well to avoid a recession? And does this mean that the public sector just becomes a larger share of the economy for the long term?
What I think is that we're in a transition period where governments are getting much more involved in the economy and in life in general. We went through a period of what we called at the time economic rationalism, and we now refer to as neoliberalism, where Milton Friedman decreed that the government sort of get out. And so we went through this period of governments basically getting out of the economy, privatising everything and letting the markets go. And I think we're now shifting, the pendulum swinging back. So governments are getting much more involved in general in industry policy, fiscal policy, monetary policy. Obviously, monetary policy is run independently by central banks, but if you sort of group them together as sort of government authorities and so on, I think that that the governments, broadly defined, are getting much more involved in running things now. And so I think certainly the pandemic taught governments how much power they have fiscally to control the economic outcomes.
And so how would you rate the performance of our government here in Australia?
Well, I think the performance, firstly in the GFC, was great. I think that the way that they, and that was largely a result of, I think, Ken Henry in Treasury saying go hard, go households, and they kind of they did what wasn't required. I think the performance during the pandemic was pretty good. They probably were too panicky in the pandemic. They went possibly arguably too far, further than they needed to. But nobody, it's easier to say now with hindsight that it turned out to be better than you might have expected. But at the time, everyone was staring at the abyss, didn't know what was happening. So it was, so they went hard. They went with all the JobKeeper policies and all that stuff. And I think that was fine.
Isn't there a danger that it leads to an expectation that we'll always be protected? That there's, we're just not going to have recessions and there's no downside risk, there'll always be upside.
That is absolutely the danger.
And people
Correct.
expect governments to protect you from these things.
Absolutely.
Whereas older generations didn't expect that and they had a recession every 10 years.
That's right.
But is that a good thing or a bad thing?
Yeah, it's good question. It's called moral hazard.
Yeah.
It's expect that you'll be rescued all the time. Yeah, look, it's interesting. I think back obviously I wasn't around at the time, but when the stock market crashed in 1929, the Federal Reserve actually increased interest rates and reduced money supply, and the government imposed tariffs.
Yeah,
on
they made everything worse.
And it just created the Great Depression. And it was the New Deal of Roosevelt that sort of rescued stuff. And so I think I'd look back on that and say, well, what they did in 1930 was a mistake. That was bad. And what FDR did was good. So I suppose I do think that the governments do have a job to keep people employed, and that's it isn't a good idea to have 10% unemployment. Yeah. And as to what the level of unemployment should be, I don't know. But I think that it is the government's job to look after the citizens.
Do you think, for example, at the moment that the very high level of public spending that we have in the economy is leading to problems like low productivity growth in Australia, which some are arguing to be an implication of too much government involvement? Yeah,
look, I think that you shouldn't underestimate the impact of the NDIS on this. It seems to me that the government's starting to become, in a sense, overwhelmed by the NDIS and the size of that task. And it was possibly, poorly set up so that it was demand driven and, uncapped and all this stuff, and it's just gone crazy. So, and that does seem to be possibly having a negative impact on productivity, because the whole kind of thing about the NDIS is looking after disabled people, and it's not productive in the sense of GDP per hour worked and so on. So I do think that that's kind of become a very kind of big part of what's going on in the government, and it's a big part of the increased spending. I think that the government's 2 surpluses in a row, fine. It's not fundamental. It's not underlying structural surpluses. That they're going to go away fast. But look, they did it. They good on them. 2 surpluses, well done.
But you used the word pendulum, and I like that one because you could argue after the Great Depression, the pendulum then swung towards some interventionism with FDR, and in the post-war period, governments were rigidly focused on avoiding a big rise in unemployment. And some would argue that led to the slowdown in productivity and the malaise of the 1970s. So then there was a backlash against that, which led to Reaganism and Thatcher and Hawke and Keating in Australia, though they probably wouldn't admit it, but they're in the same camp, which then led to smaller government, get government out of the way following Friedman. Now there's a backlash against that, and the pendulum has swung back to where we were. You could argue this is just normal part of the cycle, and we'll go through a decade or two of more government. Eventually that'll lead to low productivity. There'll be a backlash and everything will go back towards economic rationalism.
I mean, look, I think that you're right, that it was a pendulum and, I mean, we had 2% unemployment for a couple of decades.
In the 50s, 60s.
50s and 60s, right? So that, now everyone regards that as impossible, that full employment is 4.5%, 5%, Well, why do we have to accept that? I don't think that's necessarily the case. But I think that the backlash you talk about was sort of ideological rather than economic. It wasn't based on productivity went down, we need to do this to get productivity up. It was philosophical, driven by Hayek primarily, and then and Minsky and these philosophers who then led to sort of the Austrian school of economics and Milton Friedman and all that stuff, and that just and then Friedman created this movement, I guess you'd call it.
But it became very popular at that period in the late 70s, early 80s. It was people were thinking, well, this isn't working. I remember my father telling me that whatever policymakers do doesn't seem to work. The old rules don't work anymore because we had this constant period of high unemployment and high inflation. And then Reagan comes along and says, well, it's all government. There's too much government involved in things. And then we had the deregulation and
but how much of the 70s recessions and bear market was due to the Vietnam War and the oil shock of 1973, and those were particular times, and the Nixon shock of 71 where he took the US dollar off the gold standard. So there were events that occurred that were arguably unrelated to the sort of fundamental economic changes.
Just moving on to something else. A few years ago now, you set up the Constant Investor and you put out a fantastic little summary of principles. And one of them, which I kind of relate to, believe it or not, as an economist, was don't rely on forecasts. I think you're referring specifically perhaps to point forecasts. I know Warren Buffett has said that. And the comment is in relation to investing. Don't rely on forecasts in investing. And I'm just wondering, you're also from the media. The media are renowned for asking economists to provide point forecasts. I think the media knows that they're probably going to be off at the end of the year. Then they do a review and says, well, everyone was off. But to some degree, you're heavily reliant. The media is heavily reliant on forecasts. They love them. And then there's the question of what do you define as a forecast? Is it a forecast just as to what the RBA will do, or in terms of the level, or just the broad direction? So I'm wondering how you square all of that as a representative of the media that seems to be in love with forecasts.
Yeah, well, everyone in the media is a goldfish. We have a 5-second attention span.
Yeah.
So we kind of go along and looking for today's story, and today's story is Shane Oliver says the Reserve Bank's going to do X. That's today's story, right?
And you move on to the next thing.
You move on to the next thing. So that's kind of the media.
But say even when you look at the Eureka report, you will do podcasts with people like Deanna and myself, and to some degree we're putting out forecasts. But then how do you think investors should use that in terms of formulating their portfolios?
Well, the fundamental problem is that investing is an act of forecasting itself.
It is.
Because you're doing something about the future.
Yeah, dependent on the market going up.
And whatever. I mean, you're making a decision that's based on achieving something in future.
Yeah.
Investing is not about the past, it's about the future. So therefore, investing is inherently a forecast. You can't escape it in a way. But what I meant by that, and what I think, is that you've got to make your own decisions about what's likely to occur, and some sort of basing it on a forecast that GDP next year is going to be X percent, or interest rates are going to be this percent, and so on, is probably a fool's errand.
Yeah.
Because the forecasts are pretty much always wrong. And that but to recognise that you're making a decision by investing, you're making a decision about the future. And so then you've got to understand what's the basis of that decision. What are the things that you're that you think about the future. And I suppose what I think is that the thing that you're investing in is the main thing. You're making a decision about what that's going to do next year and in 5 years' time. If it's a company, you're investing in that company. And a factor in what that company does in a year or 5 years' time is the economy, but it shouldn't be the main thing. You shouldn't be buying shares in whatever it is, Commonwealth Bank or BHP, based only on your forecast of the economy. It's got to be based on how's that company going? Is it well run? And are you paying too much for it?
I guess the way I look at it is kind of, if you're a longer term investor, you're betting that the economy will continue to grow over the long period. And that is what underpins growth assets like shares and property and so on. As opposed to trying to predict all the wiggles, which is incredibly difficult.
That's right. Exactly.
There's another aspect to it. I mean, I'm thinking about economists, and Deanna and I were talking about this one yesterday, that, at the start of the year, 3 cuts were expected in Australia, now 0, maybe we'll get 1, but maybe not. Likewise for the US. And in a broader sense, you could argue, well, the key thing was actually not so much your forecast for the interest rates at the end of the year, but your forecast that interest rates would eventually come down, that inflation would improve, and that it would all occur without a recession. Now, I know this is a per capita recession, but a recession that drags on company profits. That is the key if you're thinking about the next 12 months, that broad brush assessment, not so much the precise amount.
Exactly, that's right. And so the soft landing is the scenario.
Yeah.
If that's what you think, then you're fine. I mean, if you think it's going to be a hard landing, you should wait and buy them in the middle of the hard landing, because you'll get stuff cheap.
Yeah.
Yeah.
Alan, going back to your book, you spoke about the reasons for why we're in this housing mess in Australia. Can you just go through some of the key reasons that you found?
So when I kind of started approaching how to do the book, I thought, well, I need to determine firstly what's happened to housing, what's the right measure of it, because we're talking about affordability rather than the nominal level of house prices, and then try to determine when it happened, because that might inform why it happened. And so I got these charts of the house price to income ratio, and it's really clear that the house price to income ratio started rising in 2000, really quite sharply. Up until 2000, house prices and incomes basically went up at the same rate, about 3 or 4% per annum. And after 2000, house prices started rising at 6 or 7% per annum, and incomes kept going at the same rate. So compounding at 6 or 7% per annum over 25 years, we've ended up with a doubling of the house price to income ratio from 3.5% to 8%.
And even worse in capital cities.
Yeah, that's right. But I'm just talking at the national average, but yes, it's worse in Sydney for sure. Although incomes are different in each city. So in fact, the least affordable city in Australia at the moment is Adelaide, because incomes are lower and their house prices have risen quite quickly recently. But anyway, so obviously I began the process of what the hell happened in 2000. And it was a business tax review that took place in 1999, commissioned by Peter Costello to provide them with a reason for cutting the company tax rate from 36% to 30%, which is what Howard and Costello wanted to do. And they asked these 3 businessmen to provide them cover for that. And in addition to recommending that, which is what they were supposed to do, recommend cutting the company tax rate from 36 to 30%, they did that. They also recommended that the capital gains tax regime should change from being adjusted for CPI to being a discount of 50%. And so on December the 23rd, 1999, capital gains tax was changed from being a CPI adjustment to being that you only had to add half of any capital gain to your income for your tax return. And that, I think, was a big deal. That was an important event. And a lot of housing experts say, well, yeah, but if you changed that back now, it would only have a minimal effect. The actual mathematical effect on house prices of that change was no more than 2%. the Peter Tulip and other housing experts say that if you changed negative gearing to what the Labor Party wanted to do in 2016 and 19, and you shifted the capital gains tax discount, it would only affect house prices by 2% mathematically. That's true. But what I think occurred in 2000 was a change to the way we think about housing, and it was a psychological impact. Whereas previously, capital gains tax was CPI adjusted, inflation adjusted. Nobody gets inflation. Nobody really understands what it is, and the idea of adjusting your capital gain for CPI over the period you've held the asset, nobody understood it. But everyone understands a 50% discount, and it kind of changed the thinking.
Psychology.
Changed the psychology.
So it made negative gearing more attractive.
Made negative gearing very attractive. It meant that, you could, because negative gearing obviously is based on losing money while you hold the asset, because you get to deduct the loss from your other income. So normally if you're investing in something, you don't want to lose money. I mean, that's a bad idea. You want to invest to make money, right? And so, but suddenly negative gearing was okay, because even though you're losing money, you're only going to pay tax on half the capital gain. So negative gearing is all about the capital gain. You only invest in an asset
that's losing money.
That's losing money because you think there's going to be a capital gain at the end.
Yeah, that's true.
And if suddenly the capital gain is taxed at only half of it, then suddenly it looks even better.
But I guess the counter argument is that, I would see 2000 as critical as well. And two things happened at that time. One was that people decided that inflation was, the inflation dragon had been slayed and interest rates would be lower for longer. And that came out of the early 1990s recession, but people didn't really believe it till we get to the 2000s. And so people then started borrowing more on the back of financial deregulation that enabled that. And then, of course, from the mid-2000s, you had a big step up in immigration levels in Australia, which used to run at 150,000 net migrants per annum to 250,000. We should have been building more homes, but we didn't. The completions remained at the same level, except for a spurt around 2015 with the unit building.
You're absolutely right, Shane.
Those two things, housing supply shortfall relative to surge in demand, and then it was possible for people to pay more because they could then borrow more. Those two things were the big
So
factors.
in the book, I list 4 things that happened around about that time, around about 2000. One of them was the capital gains tax discount. The other was a big cut in interest rates at the time because of the cut in interest rates that was going on in the US in 2000 in response to the dot-com crash of 2000. And whereas the US had a recession, we didn't. So we had a big cut in interest rates in 2000 without a recession. And so that, as you say, people started to trust in that at the time. And the other thing I didn't realise when I wrote this book, which I discovered later, is that on July the 1st, 2001, they changed the way that foreign students were dealt with. And so up until that day, foreign students from gazetted countries could easily come to Australian universities, and those countries were obviously UK, Europe, US, Canada, New Zealand. And was virtually impossible for people from non-gazetted countries to study in Australia, and that was India, China and other Asian countries. And suddenly that distinction was removed on that day. And also the pathway from those temporary visas to permanent residence was made easier. And
so you had a lot more people staying here.
And that took a couple of years to have an impact. But that when you talk about the big increase in immigration that took place from 2005, that was the reason that happened. It was because of the change to foreign students, which they started flooding in from India and China, and then started to get permanent residence. So it wasn't an increase in permanent migration. It was an increase in temporary migration for students who then got.
But then they became permanent. So
they became permanent, exactly. And so, in fact, the immigration between 2005 and 2008 or 9 tripled. It was unbelievable what occurred. And you keep publishing graphs showing the housing shortfall.
Yeah, I think it's a chronic problem.
And so, and what's clear is that there was a 10-year undersupply of housing from 2005 to 2015.
Yeah, we started to get on top of it in 2015 onwards with
Yeah.
the unit building booming. We used to do a crane count. You could look out there and see all the cranes. Fantastic. And then it all blew apart with the GFC. And now the unit builders tell us it takes twice as long to put up a block of apartments.
And cost twice as much.
And cost twice as much. And everyone wants a house now, not an apartment. But it seems like we're back where we were with a situation of undersupply as bad as we had it, if not worse, than we had prior to the GFC.
Exactly. And now the governments are now focused on housing affordability.
Yeah.
And their answer is supply. That's because nobody's going to touch negative gearing and capital gains tax anymore. They flew a kite about it a couple of weeks ago and have withdrawn.
Treasury's apparently looking at it.
They'd love to do it because they'll raise billions of dollars. Yeah. Sure. I mean, Treasury wants to do it, of course, but the politicians have ruled it out.
So what are your solutions that you propose in your book about how to fix the mess that we're in?
Well, in the book, I came down to if you accept that they're not going to do much about demand.
Well, they have slowed down student arrivals.
They've slowed. That's right. So that's not going to be enough. Australia needs migrants. We absolutely can't do without immigrants. So the migration intake will come down a bit, but not that much. So demand will stay relatively high. There has to be an increase in supply, and the government's now focused on that. But
that's good, I think.
Yeah, that's fine. And the Victorian government has given the councils, and the New South Wales government has done the same thing. They've given all the councils a target that they have to meet in 5 years, or in Victoria's case, 20 years.
I think there's a bit of that in Sydney as well.
Yeah, that's right.
And what happens if they don't meet it?
Nothing much, but they've got a target. I mean, what the state governments have said, and this is in response to the National Housing Accord that was done a couple of years ago, where they all sat around and agreed to build 1.2 million houses in 5 years, or dwellings, I should say, because it's worth knowing that what they're building is apartments, not houses. It's and the whole project is about raising height limits around stations. Mm-hmm. Now, in the book, I kind of got pessimistic about the ability to densify the cities, because I think that we Australians won't really probably accept it. I don't think we're ready to have dense apartment, high-rise cities
like in Europe.
Yeah, I don't think Australians want to do that.
So therefore, we should be focusing on decentralisation.
Precisely, but the trouble with that is it's too expensive.
Yeah.
So you need to have. So I kind of in the book I was saying, what's needed is fast trains to get to Bathurst in an hour instead of 2.5 hours, right? You need to have a fast train. The trouble with that is you've got to replace the existing line to have and I'm not talking about bullet trains. I'm just talking about a train that goes 200 k's, not 350 k's. But the trouble is trains that go more than 70 k's an hour can't go on the existing lines. They have to redo the lines, and it's too expensive, right? No state government's got the money. So the solution that they're doing, which is to build high-rise apartments around stations in suburbs, is cheap. Mm. All they have to do is give the developers a tick. You're allowed to build 50 stories, around Willoughby Station or whatever it is, and off you go. But the trouble is that the cost of doing that is so high now that apartments are becoming a luxury item. Yeah. They're not affordable anymore. You can't. There's not affordable housing at all. You can't. Yeah. So
is the solution then for the government to subsidise the developers?
That's right. So that's the only way to have a new wave of affordable housing in Australia is government subsidy, which is why they've set up the Housing Australia Future Fund, and they've put $10 billion into it, and the job of and that's the income from that is to be used to subsidise developers, in particular super funds. What they're trying to do is mobilise the superannuation to come in to build apartments, and the super funds invest in them. The trouble is the super funds require about 9% return. Yeah. And the last thing we want is housing to continue to provide a 9% return, which is a 6% capital gain and 3% 3% yield, right? That's the problem we've had, is the 6% capital gain and 3% yield for 25 years. That's the problem. But that's what super funds require. And so that has to be halved. That 9% has to be halved through government subsidy in order for it to work. And the Housing Australia Future Fund is not big enough. $10 billion is peanuts.
But back to the decentralisation argument. I mean, we have shown through the pandemic we don't all need to work in cities. You can just encourage more people to relocate to regional centres if they're in an industry where that's feasible.
That's
we
right.
just need to change our thinking, and the road networks have been improved. So you could argue, well, that should be feasible, at least up and down our coasts and so on.
Sure. Look, and that's right. And so working from home has become a bit of a revolution, except that it doesn't apply to everything.
No.
There's only some jobs that you can do from home. And secondly, CEOs are now starting to tell everyone to come back in the office.
Yeah.
I don't know what AMP's doing, but lots of companies, ANZ's saying, no, you've got to come back in the office now, 5 days a week, sorry. So I don't think CEOs want working from home anymore.
Yeah.
Well,
some do, some don't. There's a bit of a range there.
Well, I know, but it's coming back. It's being restricted.
The pendulum swung too far.
It's pendulum swinging back. Yeah, it's working from home. So, I think.
And then what about some tax changes that the government's spoken about, potential changes to negative gearing? Do you think that they would touch the capital gains tax concession?
Well, as I was saying before, the changes to negative gearing and capital gains tax that were proposed by Bill Shorten in 2016 and 19 wouldn't change house prices much.
Psychologically, it could.
It could, that's right. So, but they've got to be part of a. So I think we're now at the point when just changing those things would not change the psychology of investing in housing. I think everyone's now pretty convinced that the way to build wealth is through housing. Basically, Australians have got this now embedded.
But from an overall tax point of view, you could argue our income tax rates are too high, the thresholds are too low. We rely too little on GST, and we've got these tax concessions, which some would say are too generous, particularly the capital gains tax discount. Too generous. So a simple compromise would be eliminate the capital gains tax discount, take it back to what Paul Keating had up till 1999, tax the real rate. No one would understand what it is, but at least your discount is substantially gone. Limit negative gearing. I think there's a fundamental case to keep it, but some people take too much of advantage of it. So limit it to, say, 1 or 2 homes or a dollar amount. And at the same time, use the revenue you get over time to bring down tax rates. So both sides in the argument get something, and you end up with a better tax system.
Sure. I'm totally in favour of all that. I think tax reform...
But the odds of it happening are quite low.
Well, I think tax reform is a good idea, is required. We had the Henry tax review in, 2010? And, Ken Henry put together a pretty comprehensive package. It didn't include negative gearing and capital gains tax, but, I think as a part of a generalised tax reform, I think it's a good idea. I'm not sure about putting up the GST rate. I think that...
Well, it is an interesting graph. It's the share of government revenue and GDP, which is the GST tax collection, has been steadily declining. Whereas the reliance on income tax had gone back to where it was at the time of the 2000 Howard changes to the tax system, cutting income tax rates in favour of GST. So all of the work that's been done has been substantially unwound. The income tax share has gone back up again.
Yes. Yeah. No, that's fair enough. I think that just getting back to the psychology of investing and the sort of the way that... I do think that one of the things that's required for housing affordability to improve is for us to stop seeing housing as an investment, more as an essential service or a thing that we actually just live in. And
that sounds like Xi Jinping. Housing is for living, not for...
Precisely. Well, that's... I think he's right. That's what housing should be seen as, a human right. I mean, we regard lots of things as essentials and we regulate them accordingly, such as electricity, gas, all to heat the housing that we buy. But the house itself is unregulated, right, and is seen as an investment. And the trouble with seeing something as an investment is it has to earn its cost of capital.
Yeah.
Investments need to earn a cost of capital, and so I think in order for this to change, we need to change the way we see housing. And the trouble is, I don't think just changing negative gearing and capital gains tax discount will achieve that on its own.
No, I agree.
I think it would take 10 years or 20 years of house prices not actually moving. And in order to achieve 10 or 20 years of house prices not changing, we require an oversupply of housing for that period of time. So there needs to be, in order for housing affordability to improve, we need an oversupply of housing for at least a decade. And the governments, to their credit, are trying to do it. They're trying to do that.
Yeah, the 240,000, 1.2 million over 5 years, 240,000 per annum. If that occurs and immigration levels are back to pre-COVID levels, then you would get there.
You would have a bit of an oversupply. That's right. Not a huge.
Not a huge one, but you'd start getting there.
Yeah.
And over a decade, you might get back to oversupply.
So I think that change in the house price to income ratio that I mentioned, from 3.5% to 8% or whatever it is probably locked in.
Yeah.
That's a step change in Australian society that has occurred and won't be unwound, in my view. I mean, all we can try to achieve, I think, is that it doesn't get worse. Because, in order for that ratio to go back to what it was, there would have to be no change in house prices at all for a long time, for 20 years.
Yeah.
For incomes then to catch up. And
that seems unlikely.
Well, not only is it unlikely, no one wants it. I mean, my kids have just all bought houses, and the last thing they want, they absolutely are desperate for the price of their house to go up.
It used to be the baby boomers, and then it was Gen X, and now the millennials all get a house, and they don't want prices to come down. So Gen Z
they don't want house prices.
They'll get a property, and then they want prices to come down either.
They don't want house prices to stay where they are.
But do we really think that Australia is that different to any other major Western country? Like, I looked at the home price to income ratios in Vancouver, in Auckland, in Hong Kong, in Europe was a bit better, in LA, New York. They're all pretty comparable.
They are, that's right. They've gone up. But what happened in Australia will happen everywhere.
But if you compare Austin, Texas to Perth, you got these sort of mega cities where there's an issue, LA, New York.
Even if you just look at a national average, though, for the US, for Canada.
Still below Australia.
They're all pretty comparable.
It is, it's true. She's right.
If you look at demography, the US is below. You've got median cities. You've got lots of cities across the US, like Detroit and ordinary cities, where the house price to income ratios are quite low.
Yeah, I guess for the US as a whole, it is still lower than Australia. But I'm just saying the major capital cities.
The major capital cities, there's a problem there. But
I think it's just as a generalisation, it's fair to say that the housing affordability crisis is global. I think.
The Economist keeps writing about this.
Well, it does seem to be the case.
But if you look at the OECD used to have that fantastic chart, which was house price to income ratios against the long-term average. And Australia was always at the top there with a handful of other countries.
No, that's true. And I think Australia is either at or near the top in those things. And the question then is, okay, well, we've pinpointed some of the things in Australia that have caused it. What's caused it elsewhere? And I think, and this is a broad generalisation, I think it's possibly true, because the countries we're talking about are all Western countries, right?
Yeah.
And there's been a huge wave of migration into those countries, and a very small proportion of those migrants are in the construction industry. So they're not building, they're all doing something else other than, all the migrants going into the US and Europe are doing something other than building houses.
But Europe is a case, like there's this argument, a lot of people used to say, well, it's all interest rates. We've got low interest rates. And then I'd look at Europe, well, they've got low interest rates or even lower, but their house price to income ratios are nowhere near where they are in Australia, across most of their cities. London, yes, they're expensive like they are here, but you go elsewhere, they're not. So there is something
because
different
everyone lives
about
in
Australia.
smaller places in Europe and are happy to rent for a long
Could
time.
be, yeah, bigger rental stock.
Yeah, I mean, each housing market
Yeah.
is different. There's much, as you say, there's much more renting in Europe than there is here, and I think there's going to be much more renting in Australia long term as well.
I grew up in an apartment, and then when we moved to Australia, we moved to a house. Maybe people need to be, and everyone around me grew up in an apartment, living overseas. So maybe we just need to be, this great dream of having a house with a backyard. It's not really a reality anymore, and maybe that's fine, but we just need to accept it.
That's right. I think that.
But is that a good thing? It blows up a key part of Australian culture.
Exactly. So I'm saying.
But you could go to a park and have the same sort of experience that, like, this is what happens in Uzbekistan, where I'm from. You have big apartment buildings, and in the centre is a massive playground for kids to play in, and facilities and benches.
You're not your
It's
own.
just a
you're
different
not king
sort of
your own
lifestyle.
castle, the king or queen of your own castle.
No, that's right. So I think that is the thing that's going to have to confront Australians. Are we ready for that change?
Maybe they have no solution though. That's sort of the
solution
future.
that is the solution is that governments are building are encouraging the building of tons of apartments. That's what the solution to Australia's housing affordability crisis is: the building of apartments. And so, that's it. We are going to have to either get used to it or put up with high prices. I mean, if you look at the charts, unit prices have not gone up anywhere near as much as houses.
Well, that's because people wanted the houses, particularly through the pandemic.
People want houses. That's right.
Continued to some degree.
Well, it's not just the pandemic, but it was more in the pandemic. The people wanted to get away from each other.
Yeah.
But that's true. But you're right. The Australian culture is about housing, about houses, not apartments.
Yeah.
And it's about owning them, not renting them. And part of the reason for that is that the rental deal in Australia is terrible. I mean, you can't get a long lease. You can't do what you like to the house. You can't have a pet. Like being a renter in Australia is bad.
Yeah.
In the Europe, I think you got a lot more rights. So in order for that kind of change to take place where we accept renting, there has to be a shift in the balance of power between landlords and tenants.
Yeah. But again, that seems unlikely unless you encourage a lot more corporate involvement in the rental market. Or institutional. It needs to be institutionalised. But then you demand those higher returns that you.
Well, that's right. But that's another thing the government's trying to do is to encourage what they call build to rent, which is institutions building apartment blocks and then owning them and renting them out, super funds in particular. But to make that work, without there being a 9% per annum return, you need to have it subsidised. Yeah. And one way they're doing that is by increasing the depreciation allowance. Which they've actually announced. They have actually increased the depreciation allowance, I think, from 2.5% to 4%. Not a big change, but it's kind of decisive.
Thank you so much for coming on to Simplifying Investing, Alan. It's been a pleasure to have you on.
It's been a pleasure to be here. Thanks.
For more info on Shane and Diana's podcasts and reports, head to the Insights Hub at amp.com.au.